Good morning and welcome to the Leadership and Insurance podcast. I'm your host, Alex Bond, and I'm very fortunate today to be joined by not one, but two great guests and people that have actually really wanted to get on the podcast for quite some time. I'm very lucky to be joined by Kevin and Brian, who are both partners and co-founders from MTech Capital. Gentlemen, it's good morning my time. When we release the podcast, it's the mythical nature of podcasts, and we're obviously doing it in the afternoon. But welcome, and you're joining us from different locations, aren't you, as well? So before we dive into that, actually, perhaps you could one by one introduce yourselves and your role within the organisation, and then one of you can take the banner of introducing MTech. But just by the way that the nature of my screen, Brian, perhaps you can run with that one to start with.
Sure. My name is Brian McLoughlin. I'm one of the partners and co-founders of MTech Capital. My partner is also my brother, Kevin McLoughlin. We founded the firm basically because we had these really complementary backgrounds, and I'll cover my background and Kevin can cover his, and then he'll talk about the firm. I was an investment banker a long time ago, and then ended up as a fintech CFO, and from that ended up as a fintech VC quite early on in the fintech wave. Call it 2003, 2004. I was 100% of the time focused on fintech investing as a partner at Upfront Ventures in Los Angeles, which is where I live, and it was Kevin who said to me in 2017, in my role as an investment banker covering the insurance space, CEOs are really interested in talking about technology. And so Kevin came up with the idea. I think it's time for me to leave my job and let's go form an insurtech venture fund. But before I get too far ahead, I'll turn it over to Kevin.
Thank you.
Yeah, Kevin McLoughlin. I'm co-founder and partner with Brian at MTech Capital. I started my career at AIG in the insurance industry. Was on the finance and investment side there for nearly 8 years, and then went into investment banking, where I spent the next 23 years covering the insurance industry. And Brian at that time was this partner at Upfront Ventures. I was coming out of investment banking. We did see parallels between the development of fintech and the emerging insurtech space, but with about a 10-year lag. And so we were in fierce agreement that there was an opportunity here to generate outsized financial returns over the next, couple of decades, really, as the insurance industry goes through a transformation driven by technology.
Mm-hmm. Mm-hmm. One other thing I'll add is that, and in our angle for the fund was to provide to insurance companies more than just financial returns, because in fact, insurance companies are our limited partners. So we decided that to have some edge in the market to drive those top tier financial returns, we should build an ecosystem for the benefit of entrepreneurs. Mm-hmm. And that ecosystem would have limited partners who are insurance companies, brokers, and technology providers to the insurance space. We'd invite all of them to be limited partners in the firm, investors, if you will. And in so doing, make this network available to entrepreneurs. And so we have the luxury with our fund, and we launched the fund, by the way, in mid-2018 with $100 million. With large insurance carriers as our investors, and some brokers as well. And what entrepreneurs have quickly told us is not only you two folks and your team clearly have this expertise that we find very hard to find in the generalist VC community, but then you also have this great connectivity with the industry. With all of it, yes, you're limited partners, but then the 100 other insurance carriers and brokers and technology providers we keep in touch with, because yes, we'd like them to be an investor in a subsequent fund. But in the meantime, we want to make sure that our portfolio has, our CEOs have access to this network. And we borrowed the idea from my old firm's experience, where MasterCard was an investor in Upfront, and it was to get the same strategic benefits and insights from us as investors in fintech every day. We borrowed that and brought it to MTech Capital, and it's worked out exceedingly well. And so as a result, we can be a stage agnostic investor, meaning we can invest from a PowerPoint presentation pre-seed all the way to late stage. And even in a late stage round where an entrepreneur is raising, $40 million, and we can only write a $3 million check in our small fund, they are happy to take our money. They want our insights. They want our connectivity in the market. They want access to that ecosystem. And they often invite us to be a board observer, even with that relatively small check. And I want to say, out of 22 core investments we've made out of the fund, I think we're on the board as either a proper board member or as an observer in 19 out of 22.
Sure. Yeah, it's interesting. I mean, I think my naivety when I first started dealing with venture firms, and that's how we get some of our strategic relationships. We're a recruitment provider. We tend to kind of engage with certain venture firms' portfolios. Is that I didn't realize quite how important it was. I thought it was all about writing checks at the right time, and the sort of power of the networking appears to be the differentiator. Because I'm skipping ahead here, but we're touching on it now. It's like, is that how you would draw your key differential as a venture capital firm? Because it is hard, I think, at times to kind of differentiate the offering. Because I think that sometimes comes down to the business is trying to get funding. The way that they view the venture partner that they're looking for, the way they look at investors. The smart money goes to the smart entrepreneur, one would assume, who knows that they're getting more than just a check. So perhaps you could answer this individually. That is that your differentiator, as you touched on, the networks, or is there more to it than that you would see as what makes MTech Capital as a different venture partner than other businesses?
I think it's our ecosystem, as Brian outlined, and it's our backgrounds. So I think we bring a lot to the firm, and therefore a lot to entrepreneurs. So if they are in the luxurious position of being able to choose which VC firm to take funding from, and kind of at that point, all capital is fungible. They are looking definitely for what VCs can add over and above capital. And so, yes, that network comprised of our LPs, but also, as Brian said, our broader insurance relationships globally are critically important as a differentiator. I mean, we can open doors, make introductions to a lot of carriers for them. We also, by the way, use that ecosystem to, I would say, let's say, vet or provide additional data points in our due diligence exercises. We are, of course, entirely independent in terms of what we invest in, but that ecosystem has, multiple benefits for us and the entrepreneurs. So that's a key differentiator. And then second, our backgrounds.
Sure.
One other thing I'll add, Alex, is because if you think about the, likely recession we're heading into, if we're not in one already, capital providers are pulling back. And so when you're sector focused, when you have deep expertise, I think two things are at work. One, you can have conviction, and we feel this ourselves. When we see a great entrepreneur working at a really hard problem, and we believe that there's a likelihood of success there, we can have greater conviction in a down market or in a scary market than, let's say, the generalist VC who's just not sure and is not sure maybe what price to pay. And so I think this will serve us well in the next 24 months or so, as it becomes a lot harder to raise capital, and prices should come down. And of course, they have already in late stage opportunities. And so I think there'll be some great companies either formed or financed in the next 2 years. And we intend to be part of those in the insurance sector.
I was good. I want to dive into that, but we're starting to touch on all these great questions that I'd lined up. So I'm gonna bring it back to something very, very. You two guys are in such a unique position to answer this question. So we've had European-based funds, we've had UK-based funds, and we've had an American VC fund, all insurtech specific, that have come on the podcast. And we're always kind of having this conversation about the style of investing in UK and Europe, and the style of investing in US, and being slightly different. Well, yeah, you two gents are obviously different sides of the pond, and I was wondering, you've got a unique position to have insight. Do you find there's a different approach to venture investing in the UK as opposed to US, or is that something that we just like to tell ourselves is just UK loves to be special? So I think the UK particularly. But do you think there's a different style there?
I think it's getting less so. If I think about, even at my old firm, we had an office in London and in LA as well. So it's a carbon copy of our current setup. And it used to be starkly different. And even there was a slight difference between East Coast and West Coast of the United States. And if you went from, if West Coast was pure gunslinger, just look at the entrepreneur, make a bet, who cares what the terms are in the term sheet? We don't need any protections. You had a slightly more structured approach to term sheets in New York, let's say, compared to the West Coast. And then once you got to Europe, you could 2X it. There would be even more structure and concern about governance. And I feel like that has lessened over the last, certainly over the last 5, if not 10 years.
Sure.
But then there are still idiosyncrasy differences between countries, or among countries.
What about you, Kevin? Do you echo that? Do you echo that with the London base? Does that resonate with you? Is it becoming more closely aligned?
Alex, to be honest, it never crossed my mind. I think fundamentally what we look for in companies is the same, and regardless of geography. The way we assess founders for talent is the same. The financial metrics are the same, and the execution process is essentially the same. So no, I don't really see a difference.
No, interesting. I think the general kind of consensus was that the US-based funds were particularly kind of happier to write bigger checks at earlier stages. I think that was typically what we see, and I see that from a recruitment standpoint. We tend to work with businesses that, whatever someone calls a seed round in the US is usually sort of much bigger, but then that could be reflective of the target market if they're going after US insurance market.
In that respect, yes. I mean, the last time we looked at it, the US venture capital market was 8 to 10x the size of the European venture capital market. So it's not arbitrary that you get some larger insurtechs in Europe who will migrate to the US when they achieve a certain size and need to raise kind of very large amounts of capital. So we do see definitely a deeper market in the US for venture.
And Kevin,
it's also true, Alex, that we have to assess market opportunity on a country by country basis. You can't simply look at the EU and say, oh, there's an EU opportunity here. The insurance, the structure of insurance in each of the markets is sufficiently different and heterogeneous that you do end up sizing, let's say, for a UK company, what is the UK opportunity, and then where can they go from here?
Mm-hmm.
And in more than a few cases, UK companies choose to come to the US rather than to their next door neighbors in the EU.
Yeah.
That's a really good point. I would say that what is noticeable, Alex, is while the EU is a single market, so if you start an insurance company, whether it's marketing or a regulated entity, right, you're passported across the whole EU. As Brian is alluding to, there are, frictions still going across country, and language and culture are obvious ones. But sometimes the structures of the market are different. I would say that insurtechs in the US, while there are 50 state regulators there is considerably less friction, right, in expanding your business. So if we're talking about a comparison of the two geographies, I would say there's probably an inherent advantage given to the US insurtechs to the extent that they've got an enormous market, and it's virtually a single market, notwithstanding the fact that you've got 50 different regulators.
Mm-hmm, mm-hmm. That's interesting, particularly as well as we're moving towards, not moving towards, but we've seen more of an interest in SaaS-based investments rather than, if we take the kind of evolution of what we've been looking at in the insurtech space, there's been lots of kind of digital MGAs, digital insurers, and there seems to be kind of a lot more interest in SaaS propositions that help the existing market. That's obviously you're outside of regulation then, or particular most regulatory challenges, because one of the challenges of regulated markets is obviously the sort of geographic differences. Yeah, that's something that we've seen in terms of growth, but particularly the SaaS-based companies that we work with in the the UK. It's always, point one on the map. Let's go to the US as quickly as possible because it's just such a big addressable market. I did want to ask you about this kind of London and US piece because, look, I know, particularly because you're an insurtech-focused fund, I'm gathering that circumstantial because looking at your background, Kevin, you've been in London quite a long time, so that was probably always going to stay the case. But does that give you a particular strategic advantage having those kind of two, particular hubs of insurance and insurtech innovation? Do you think that gives you an advantage as a fund that some other funds don't? Because lots of insurtech funds are relatively small. They tend to be solo location. Is that a sort of happy strategic advantage that you've managed to?
I definitely think so. And it was a fortunate coincidence that Brian was based in the US on the West Coast and I was based in London, because if you were kind of designing the firm, and from a geographic dimension, strategically, I think you want to be in London, which is, really got a deep insurance culture to it and a very vibrant insurtech scene. And it's, of course, a gateway into the rest of continental Europe. Mm-hmm. And then in the US, being on the West Coast and the whole technology, history of West Coast US, I mean, it's a great place for Brian to be. So it's a coincidence because it was kind of a personal decision, probably less career based, that we live in these two locations. But from our fund standpoint, I think it's ideal.
And our limited partners certainly see value in it because in many cases they're operating across those same geographies anyway. And it is not one way that every good idea in insurtech comes from the US and then gets borrowed in Europe. In a good number of markets, innovation is started in Europe first, around insurance, and then has in some way or another come to the US. And so seeing what works in which markets and when provides valuable insight, not only to us in our investment activity, but also our limited partners who are looking for a set of eyes and ears in other markets as well.
I'm just thinking that it makes you particularly attractive if I'm a UK-based insurtech looking for investment, is that because you've got those two sides of it, that we get this we can get an investor that is in London that we can face to face with if we need to. But then you've also got these kind of boots on the ground and LP knowledge and network in the US that you can say, okay, once we kind of get to a certain size in the UK, if we want to expand into the US, you've got that network, and it comes back to those power of those networks again that you've shared, which I think is a really interesting proposition. I wanted to change tactic a bit because there's something really important I think that you've got on your website that I wanted to discuss with you both, because it's something I've had a conversation with a lot in my kind of recruitment hat. So you've got an ESG policy on your website. Diversity goes beyond optics, and I love that, and I think it's a great thing to have on your website as part of your ESG policy. But what role do you think venture plays in driving the sort of diversity, equity, inclusion agenda? And I suppose taking that, let's take it with that. And I wanted to talk about practical terms and kind of what you do about that. But what role do you think venture should play in the sort of diversity, equity, and inclusion agenda? Who wants to take that hot potato?
I can answer that question with respect to MTech Capital rather than speaking for the whole venture industry.
Yeah.
We didn't set out to build our portfolio of 24 companies with diversity as an explicit goal. Mm-hmm. But in fact, we have nearly a quarter of our founders have diverse backgrounds. And, when I think about the culture of our firm, it is based on respect for the individual, for everyone, and fairness and transparency. And so when we evaluate founders, we have those principles in mind, and we are looking for the most talented entrepreneurs, period. Kind of frankly, regardless of background, that's what we're looking for. So in short, our goal is to maximize financial return, and a critical component of that is identifying talented people. So it's actually not surprising that a significant part of our portfolio is comprised of diverse founders.
Mm-hmm. And I'll add one thing, expanding that to the industry. And maybe you'd think of this as a plug for the VC industry overall. I just think it's true that venture capital has been on the forefront of investing in, whether it's first generation Americans, coming over as immigrants. They make up an entrepreneurial class, and they get funding from the venture capital industry. Certainly in the United States, they do. And I think that pure meritocracy focus that was, you could say, was maybe West Coast based, 20 years ago, has, I believe, permeated the broader market. And if Europe was a little bit behind there, and I'm not sure that it was, but if it was, I think that's lessened a lot in the last 10 years in any case. So if we're going to compare industries, which ones are hidebound and rely on old networks, and which ones embrace the brand new, disruptor in the market who showed up from another country, or might have a different gender or other orientation. I think money, capital goes to the best ideas with the most talented people, and the CEOs who can build the most talented teams. And I think that's been true for venture capital. So, and I think it's reflected in our portfolio, as Kevin highlighted.
Sure. I think it is true for venture that the right ideas get funded, but I do think it's very difficult to overcome inbuilt biases. So some of the complaints on that we've had, particularly female founders, and these people that have got funding, so they've got less of an axe to grind, was that statistically it's shown that, for example, women are asked kind of more negative focused questions. So it's kind of all about challenging the idea rather than kind of focusing on how big an idea could get. And I wondered, are there any sort of practical steps that you take as a fund to make sure you're seeing a diverse bunch of founders coming to you and you're attracting those kind of ideas, or is it just because my worry is that if it's all about networks and networking, it's kind of the people that are outside of those networks that we need to kind of try and accommodate. So I just wondered if there's any kind of practical steps you take within the business to try and encourage more diverse founders coming to you with their pitch decks, for example.
Well, it's actually important. I'm glad you mentioned this concept of what do we mean by network. Yes, we are building a network and maintaining one, but at the same time, we make a brand promise to our limited partners to see everything in insurtech in all of North America and Europe, including Israel. That's our goal. I'm not sure we've met that goal yet, but that is our goal.
It's a big goal there. It's a lot of ideas.
Right. And so our team does a lot of outbound calling. As soon as there is one press release that hits a small pub that says, oh, by the way, someone just raised a seed round, friends and family, and this is what they're doing, that hits our radar, and we're reaching out to that entrepreneur to make sure we see everything. So in that regard, our filter is not, I would say, is not biased, because we're trying to see absolutely everything. Now, if you were asking that question about the industry, I think you're touching on an important topic. And that is, if you're just waiting for your friends and your professional network to send you what they think the best ideas are, then you are at risk of certainly not seeing the more diverse, non-traditional founder who actually isn't part of one of those networks to begin with. In which case they have to be found in another way. And so I think we do a good job, at least in that regard, at MTech.
Sure. No, I mean, that's a very practical way to do it. See absolutely everything. I mean, I always think about venture and hiring people in a similar way. When you're seeing pitch decks, you've only got so much capital. You only get to deploy it once. Well, in the first instance, and write that check. Yeah, it's like hiring the right person. That's the equivalent of kind of basically seeing everyone that could possibly do a role, and then you're going to get rid of kind of some of those kind of challenges of discriminatory hiring. So certainly one way of doing it, but yeah, you set yourself a hard challenge there. But it's funny though, because I was just thinking, we do that. We do that in my business. Anytime there's someone's got anything, we just want to speak to them because we're interested. And we know it's probably not for now, but it might be for the future. Because how important is it to you as well? And perhaps I can come to you on this, Kevin. Is it to build those relationships early, like even potentially before it's the right time for you to invest? If they've just done let's say they've done a seed round and you might want to get in at Series A because you've missed out, you haven't seen it. How important is it to for you to build a relationship with those founders? And how do you do that on a practical level? Because, that's a lofty goal, trying to reach out to everyone. So how do you manage that time and that outreach personally?
Sure. We, well, firstly, we have a team.
Yeah.
So we have an investment team comprised of 6 of us, 4 associates, and they are proactively every day reaching out to companies. And so we see kind of 60, 70 plus companies per month that are met with as a firm. And we just, as Brian said, we make it a goal to see the whole market. When we see a company and we determine that it's too early, we make it a point to circle back to that company in 6 or 12 months to, assess progress. And we do that, as just a matter of course, really. And it helps to be stage agnostic in that regard. Recently, we just invested in a company where we saw it at the Series A stage. We're interested to invest. For a couple of reasons we didn't. And we, after it's nearly 3 years, we now circle back and invested in their Series C. So we really do like to cultivate these relationships because it's like an M&A process. Or when you come back and revisit a founder and their team, having got to know them earlier, it just makes the whole evaluation process for us much easier. We know what to look for. We want to know what has changed during that period.
And we've also seen that entrepreneurs value what we bring at different stages in their own progress. And so some entrepreneurs want that insurtech specialized fund involved right in the Series Seed or A. And then others say, well, you know, I think I'm going to have a SaaS software VC expert lead my round. And when I'm actually ready to focus more in a one, let's say, sector or another, then I'll add, let's say, insurtech or fintech a little bit later. And so we take advantage of that as well. We see someone in a seed round and maybe a large firm shows up and takes up the entire round. We're going to be there for the next round, tracking that entrepreneur. And then we get the benefit of what Kevin just described, which is you get to evaluate a team over time.
Sure. That's something that I was interested to see recently. I was working with a company that basically had raised, they were at seed stage, but they'd done a friends and family round, but they'd managed to raise quite a significant pile of capital. And then on top of that, they'd taken what they very much determined a strategic investment, which was exactly as you described, that they went with a firm that had insurance related, similar to yourselves in terms of makeup. They had some of those kind of networks and distributions, and that was the pure reason that they took it. And in fact, they took it not really needing the capital. Is that a situation you've ever found yourselves in? And how does that play out in your world? Do you want to get the money in anyway? But if they're sort of openly saying they don't really need it, the investment, does that put you off making it? I don't know how clear that question was, but
all depends on terms. So,
sure, yeah.
You know, usually what happens, in fact, I had this conversation with an entrepreneur only yesterday. They just closed a $7 million financing. They certainly don't need any more money. They only have 5 employees at this moment. So clearly they're, in a way, fully funded, no doubt about it.
Sure.
And yet the entrepreneur was so intrigued by our approach and, quite frankly, our knowledge of this entrepreneur's business that we talked about an opportunity for MTech to invest. Now, exactly when that happens, not clear. Terms were certainly not discussed. But on the right terms, imagine, let's make it easy. Hey, instead of having 7, maybe you should have 9. And we put $2 million in right now. There'd be incremental dilution for the entrepreneur and for the firm that already invested, but they may decide that makes sense. Or maybe it's just a slight uptick in valuation, and then it still might make sense. And so, yes, that conversation happens with us regularly, especially when we discover that a company exists because there was an announcement of some capital raising.
Sure.
So it comes up maybe more often than you might think in that context.
Sure. No, that makes sense. We touched on this earlier, and it's a big topic, so I wanted to, definitely take a run at this. We're seeing a price correction. We've seen the larger insurtech stocks, not do so well. Is this a positive thing for insurtech specific funds like MTech Capital, as opposed to some of the funds that are playing in the space that aren't insurtech specific? Is there some of that price correction a positive thing for firms like yourself?
I think if you're referring to, Alex, the insurtechs that listed in the U.S., it's kind of like the 6 or so listed there, who are all down 75% or more. I wouldn't make the connection that there are. It was a reflection of overvaluation of the insurtech sector, but rather I think the loss in value in those companies actually preceded the general market. The turn of the general market at the beginning of this year. So they were already on their way down. And the takeaway, I think, from those listed insurtechs was quite simply that they went to the public markets too early.
Right.
I mean, you're just a long way from being IPO ready, unless you're, you can present kind of, financial results that have some degree of predictability, because equity analysts in the public market space, of course, they're modeling, companies' projections. They want to be able to rely on kind of guidance from companies as to what financial metrics they hit and when. And if you're just still an early stage company and you're in now the public markets and you miss your first 2 quarters of, let's say, of even top line, premium, or it could be revenues, you very quickly lose credibility in the investment community. And then it's kind of a downward spiral from there. So I think the takeaway is really that insurtech should be really cautious about being drawn to the IPO too early. They've got to really make sure their business has attained a degree of maturity and therefore kind of predictability, because that's what public market investors expect.
Sure.
And I have to say, it felt to me almost comically nonsensical that some of these companies went public. Reminded me of 1997, 1998, where companies that had no business, they did not have their business instrumented, and yet they were entering the public markets. And the SPAC phenomenon of 2021 and 2020 also made it worse. We had one of our portfolio companies consider a SPAC. And Kevin in particular spent a lot of time, talking them down off the wall, thinking about going public at such an early stage. And to think that some of these late stage investors who have, a preferred stock, right? And so they have some liquidation preference protection, were willy-nilly willing to convert to common stock in the context of an IPO and then have the stock go down 90%. They are literally down pretty big. And so I think there are some real mistakes were made by some late stage investors.
Yeah, it was a really interesting time. And we've talked about it a few times on the podcast, and that just looking at the fundamentals from a kind of really, I did economics at university, and sometimes you think, am I missing something? Because this doesn't look like it's in the right position. And then, sometimes the answer is as clear and simple as that. And I think, I think too early is a kind way of looking at it, but certainly I think probably the right way of looking at it. But
what it doesn't do, sorry, Alex, just to add one more point on that. What it doesn't do is change the attractiveness of the whole investment thesis for insurtech. So, I mean, we have complete conviction that the insurance industry is only at the very beginning of a decades-long transformation. And so we believe there are going to be some really large IPOs, someday in the future of insurtech businesses. But it's just that those that went, they kind of jumped into the public markets too early. But not to be confused with the strength of the underlying proposition, or subvert the underlying proposition of what's coming with the transformation in the insurance industry.
Now, that said, some later stage investors, given the downturn, are cautious on insurtech right now. So in that context, in the short run, I think it has been bad for business, for the sector, because some more generalist investors who can write larger checks, let's say, have become extra cautious about insurtech relative to maybe some other sectors. And I think that's unfortunate.
Yeah, you both mentioned your thesis there. Has your thesis changed in the past 12 months, given the kind of the changing environment? Are you looking for different things? And if you are, is that just kind of natural that you would evolve and change the thesis, or is it stuck very much the same in, let's say, the last 12 months?
I don't think that our theses have changed, but I do think some practical considerations can't be ignored. Mm-hmm. And so if an entrepreneur is chasing a very big idea and already has a $2 million a month burn rate, in 2021, you could be pretty highly confident that they will be able to support that burn rate by going out to raise a $50 million plus round, or even a $100 million plus round. And we had 4 companies in our portfolio raise, $75 million plus in 2021. Mm-hmm. No one, at least in their right mind, would think, oh yeah, that'll be easy in 2022. Sure. To go raise an amount of capital to support that kind of business plan with that kind of growth projected. And so the practical outcome is, yes, you might have to have a lower growth rate. Let's take that 50% plus burn growth rate down to, hopefully not less than 30. And then not augment your team nearly as quickly as you might have done in the past, and control your marketing spend to a degree that you wouldn't have wanted to in 2021, but you better now. Mm-hmm. And let's get that burn rate down so that you can raise a more modest round of capital and still be attractive to the market. So that's just a practical consideration in the current market.
Mm. How much are you involved as investors in relaying that message? Is it a message that does need to be relayed? Do the entrepreneurs sort of get it immediately? I suppose that's kind of, yeah. Where do you get involved in that conversation? Because obviously that's a difficult conversation to have. That they're aware of their burn rate, but let's say they're a first-time founder. How much kind of do you have to step in and say, look, market conditions have changed. You need to kind of have a look at that, particularly as I know you're on so many boards. How direct does that conversation have to be?
You're right. It can be a really delicate conversation. And I have to say what seems to help is if there is an imminent need for a capital raise, they are more likely to follow the advice. Mm-hmm. And so they understand that market conditions have changed dramatically. Mm-hmm. And that when we describe for them the issues that we foresee new investors will have in kind of the current configuration of the business, mm-hmm. that I think they're more inclined to listen closely at that point and make the necessary cuts. Mm-hmm. If they've got 18 months or 24 months of runway, in other words, in terms of cash, they may feel, well, I think I'll resist that because I think it might impact my top line growth by making some of these cuts.
Mm-hmm. Mm-hmm. Yes,
and then
conversation.
Kev, there's also like this emotional element to these conversations as well. And it's sometimes a big emotional element where an entrepreneur has promised that certain growth rate, now has the capital, and would be taking a big risk to just have 18 months of runway. With that much capital, they could easily make it 3 years. Mm-hmm. And I think that's when the conversation coming from an outsider like us can help, refocus what's really important, right? It's the market's changed. You probably can't meet your promises regarding growth rate. And so you'll have to get over that. And what puts companies out of business is running out of money. So don't run out of money. And you should probably think about 3 years and not 18 months in terms of what your runway should be.
Because it's a hard adjustment. I think there was a lot of people out there. Let's be honest. I think there's a certain degree of people that are skeptical of businesses that raise venture cash and then they go out and build businesses. I think there's always going to be some people that love to watch those things fail. I think that's just the unfortunate nature of humans. And what I found a bit frustrating about this period was people having to make these adjustments, and it was people really kind of almost kind of enjoying that. and saying they were bad businesses, they're badly run. And the argument I've been having is that no, it's just that the environment's changed. It was perfectly reasonable to run a business that's focused on growth, knowing that you could raise your next round with relative ease as long as you were growing and given the numbers. And now that environment's changed, and so the rules of the game have changed, and the rules of raising capital have changed as a result of that. And I always felt that was it was unfair. You know, people, I don't know, maybe it's the Britishism. We do we like to see people fail? I don't know. I think we root for the underdogs. You know, we're but have you seen entrepreneurs struggle to make that adjustment? You know, how hard do you sometimes have to push that? Is that where the various investors work together? If you're kind of multiple investors in the same fund, how does that work if you get an entrepreneur that you really feel isn't aware? They're aware because you've told them, but they're not taking the message on board. How do you manage that?
Well, Kev, I think you have an interesting example of a company, and I think it's probably true across companies, and you know, serial entrepreneurs will tell you this, that in hindsight, you probably had a little fat in your organization, and there are probably some key priorities upon which you're spending a lot of money that ended up in hindsight not so terribly important after all.
Sure.
And a downturn like this that changes the rules, as you've said, can cause you to more easily make those cuts in areas that probably weren't driving a great ROI anyway.
Mm-hmm.
And some entrepreneurs are slower to capture that opportunity than others. And some really have to be reminded more than once, hey, you probably are wasting money in this area, and now's the time to stop.
Mm-hmm.
But Kevin has an example of that just recently, which I'll let him touch on if you'd like to.
Yeah, you know, I would go back to an earlier point I made. It is kind of the imminence of a capital raise that, in my view, seems to drive the impact of your message. So in the case of what the company Brian is alluding to, yeah, they needed to raise capital. They were a few months away from running out of cash. And that certainly focused their mind. And when you had, us and the rest of the board being very clear about the importance of making really significant cuts in the burn rate, they had to listen.
Yeah.
And, in juxtaposition to that, I had a call this morning with another portfolio company that is doing well. And they've probably got about 9 or 10 months of runway left. And we talked about the idea of certainly, freezing, for example, hiring for the moment and looking across the business at some of these adjacent projects that aren't really contributing to top line growth, but are costly. And, I think that was, he listened, but not inclined to take those steps at this point in time.
Yeah.
And so we'll see.
A polite nod, but it's not getting actioned that quickly.
Yeah. At the end of the day, Alex, we're minority investors like every VC firm. And so, yes, we can sit on the board as directors or observers, but in that respect, you're the founder, the CEO presents a strategy to the board approves the strategy, and then it's up to them to execute.
Mm-hmm.
And you can provide then kind of advice in terms of course correction along the way, but it's kind of their show.
Yeah, sure. Yeah, those are like the frustrating conversations I have when I'm advised for my opinion on who they should hire, and and they go the other way, and you go, I hope it doesn't go wrong, but I've seen it go wrong before.
Sure.
Gentlemen, thank you very much for your time. I felt like we finished on a negative, so I want to give us a chance to finish on a positive, but I'll make this our last question because I don't want to overstay our welcome. I just want to know what you're both excited about. Insurtech's this very long, very broad description, everything from adjacent technologies all the way through to kind of a full stack digital insurers. What are you excited about at the moment? Is there particular things that kind of interest you? I've got a bit slight obsession with claims technology at the moment, but that's just me because I used to work in claims. Yeah, perhaps to start with you first, Brian. Is there anything particularly out there, technology-wise or other, that's interesting you particularly?
Yeah, I think there's been some investment, but there really hasn't been an impact yet on the industry in a couple of areas. One is, I think, really customer journeys are going to be remade. If you look forward, let's give it a long time. Look forward 5 years plus. How you interact with your insurance company as a consumer or a small business is going to change pretty dramatically, and I'm not sure that's really happened yet. I mean, a handful of companies have done so, but many others have not. And then the other one I'll mention is AI. You could argue that insurance is the most data intensive, or among the most data intensive industries in the world, certainly given its size and the amount of data it has. And it is underinvested in a variety of data technologies, but one in particular is the impact that AI can have on underwriting, fraud, claims, you name it. And even if you are a large international player and you've built a data science team, you ask the average person inside that company, have your core underwriting models become AI decision engines? The answer is no. Just no. Some of that's regulatory related, because you have to bring the regulators along on this journey as well. But I think that's going to be an enormous impact. And where you'll see it is you'll see the companies that embraced it versus the companies that have not. And adverse selection is likely to show up in the portfolios of the companies who have not made that investment.
Brilliant. Yeah, no, I look forward to seeing those changes. Kevin, anything from you that's specifically exciting for you at the moment?
Very specifically, it would be the potential for AI and specifically machine learning to transform underwriting. So when I look at, just focus on P&C, and you're thinking, 100 cents on the dollar, claims, right? Loss adjustment expense might be 5 or 6 points, loss ratio is going to be 60 points, and so we're focused on kind of the plumbing of insurance because we think that's where the most value creation is and will come from. And so even within that plumbing, underwriting is, in my mind, the area where there is scope for the greatest potential value creation. And so I am just fascinated by the potential of AI, big data to identify, correlations between factors across data that have high predictive power, like we haven't seen before, or actuaries haven't seen before. And so that to me is really exciting. Yes, we do see companies that are using AI in underwriting, but I have to say not that much. And we haven't certainly seen a real empirical evidence of impact. And so that's the one that I personally look out for.
Yeah, super. Yeah, no, I agree. I mean, the true AI stuff, I think we've yet to see excitement of. So yeah, I await that with bated breath. But I don't want to overstay my welcome. You've been really generous with your time. So I want to thank you, Brian and Kevin. I'm really pleased you made the time to get this done. Yeah, it was a big tick on my list of wanting you guys from MTech Capital to come along. So thank you very much for being guests on the podcast. I really appreciate it.
It's been a pleasure, Alex. Thank you.
Thank you.
Thank you, Alex. Appreciate it.
Thank you.